Well, there was plenty for market participants to digest last week amid a fresh bout of political risks in Japan and in France as well. Before, of course, we then had a bolt from the blue on the trade front on Friday with President Trump threatening China with an additional 100% levy from the 1st of November. As a result of that, we saw a very risk-off and defensive feel to trade as the week drew to a close. But it looks like this week, somewhat calmer tones are prevailing and the taco trade looks to be off and running once more. But there's plenty once again for participants to get their teeth into this week, with the start of Q3 earnings season right around the corner, and of course the ongoing US government shutdown, which still has no end in sight. Plenty for us to discuss on the trade-off this week, so without further ado, let's crack on with the show. So a lot going on in the markets last week, mainly at about 4 o'clock on Friday afternoon, which I'm sure annoyed every single trader in the UK. And did it annoy you? Ryan Littlestone from Forex Live and Forex Analytics joining me, as always, to try and make sense of everything that's going on.
Well, Michael, it was a massive, massive shock what happened on Friday. You know, we everything that went on, I think I was blown away. You know, you were there past 2:30 in the afternoon at your desk. You know, it's something that the world has never, ever seen.
Oh, for a brief moment then, I thought you were actually being serious and sincere. But, I should have known better after 150 odd of these episodes, shouldn't I?
Yeah, you should have.
Deary me. Right, well, in that case, let's open the trunk and get into Topical Thunder and see what's going on. So we may as well start with Friday afternoon, not the fact that I was at my desk. I'm always at my desk on a Friday afternoon. I have no idea where those rumours have come from, but with the issue of trade, because it seems like Tariff Man is back once again. Now, just to put a bit of context around this, I mean, it's easy to say so with hindsight, but it does seem as if tensions between the two have been sort of ratcheting up in recent weeks. And just to narrow things down, the US side, the Trump administration, clearly their back has been got up a little bit by what they see as escalatory action from the Chinese side, namely some big investigations and probes into US companies such as Qualcomm and Nvidia. And then towards the back end of last week, we had an announcement from China that they plan to put in place export controls on certain rare earths. And you'll recall that was one of the big sticking points earlier in the year. There was this whole talk of basically it was a trade-off. You see what I did there? Between China supplying rare earths and the US supplying chips. That was essentially what the negotiations were boiling down to. Well, Trump, in his own words, said that those actions are, quote, very hostile. And as a result, he sees no reason to meet Chinese President Xi, as had previously been planned, in 2 weeks' time. That in and of itself, as well as a mention that he was considering countermeasures, sent markets tumbling into the weekend. And then with even worse timing, with 5 minutes to go until futures closed on Friday night, Trump decided to tell us what those tariffs would look like, noting that an additional 100% levy would be placed on Chinese goods, plus export controls on, and I quote here, all critical software, effective from November the 1st. Now, of course, that final point is probably the most important here. The 1st of November is still about 3 weeks away. So again, at first glance, that looks like another example of this escalate to de-escalate negotiating strategy, throwing out a slightly outlandish number in the hope that it focuses a few minds and then getting some concessions and getting a deal done sooner than might otherwise have been possible. And in fact, comments that we had over the weekend from Vice President J.D. Vance very much were in that vein. And then President Trump himself, not tweeting, truthing, I suppose, posting on Truth Social on Sunday evening, saying that we don't need to worry about China and that everything will be fine in the end. So the market reaction to all that, very much as you would expect. Big risk-off day on Friday. The S&P and the Nasdaq having their worst days since April. Demand for havens like treasuries, the Swissy, the yen, and gold, while the dollar rolled over. Today, we see markets leaning back into the taco trade, the Trump always chickens out idea, the idea again that this is just a negotiating gambit and little more. Of course, the question now is what comes next? I think my view on this is it is probably taco part 3 million or whatever we're on at this point. So I think we've all lost count. But it's going to be tough for markets to erase all of the damage that we did on Friday until we get some confirmation on that front, until we get a leader level phone call or confirmation that the two leaders are indeed going to be meeting as planned, or even a complete rolling back of those threats. You would expect somewhat cagier conditions to prevail, and you'd also expect much higher levels of volatility because, of course, tariffs are now a risk that we have to be cognizant of once more.
Yeah, very strange. Very strange. It seemed like
Me or the news?
Well, both really. It seemed like again, par for the course. It did seem like it was a huge move by China. I mean, they have already got these export controls in play. We knew about that already, and they loosened them up a bit. And then reading some of the details afterwards, and they tried to roll back a bit, saying that they were going to assess things. It wasn't just a straightforward we're stopping all exports or anything like that. And the trigger really seemed to be this thing that the US is doing. We've put import fees onto Chinese vessels coming into the US, which China took exception to, and that seems to have been the trigger for it all. It does sound like both sides have overreacted, perhaps, or the message hasn't been translated across properly from the Chinese side. And now we're probably going to see, like you say, both sides rolling back a bit. But it just once again, it creates this manic moves in markets that we have to deal with. And this is part and parcel of Trump trading. But I think it's possible that we're going to see that all ease off again. The only thing that the market's doing today is it's still taking precious metals higher. It's taking silver to new highs. It's taking gold to new highs. And I think, as you mentioned in our chat room earlier, there are some, the usual shortages stories going around. But I think the fact that the rhetoric's been dialed down, but the threats are still live, I think that's what's hitting the market still at the moment, particularly in precious metals.
Yeah, I think you're right. I'm going to talk a little bit more about silver later on, and there are a few sort of idiosyncratic factors at play there. I think also the reaction on Friday was, in many ways, a little bit of a perfect storm. I know we were joking about me not being at my desk on a Friday afternoon. To be honest, 4:00 on a Friday afternoon is not the most active of times for financial markets in any week, in any jurisdiction, no matter where you are. When you add on to that the fact that both implied and realized vol have been so low for so long, we've also kind of all, and I think we're probably guilty of this as well, just basically forgotten that tariffs were a thing in recent weeks because the drumbeat of news has died down so much. And then you've got to consider that the market, certainly the S&P, has basically gone up in a straight line for 6 weeks or so. So it's almost a perfect storm of a market that, again, in hindsight, was probably too complacent about the risks it faced, suddenly being reminded in very, very aggressive fashion what those risks are in a relatively illiquid time of day. Bang, there's your reaction, 3% lower in risk or whatever it proved to be. But we are recovering some of that ground as the new week gets underway. In any case, Ryan, you're going to do your sort of Phileas Fogg impression now and take us around the world in 80 seconds rather than 80 days?
I'll try and keep it within 80 seconds. It might be 8 minutes. I don't know. We'll see. So just looking around at the global economy and potentially some warning signs for growth, just some of the data that we got last week. Obviously, we didn't get any from the US. So there's a bit of a hodgepodge topic this week. Looking at Germany last week, they had quite a bit of data out. They had factory orders, which were forecast to come in up 1.2%. They came in down 0.8%. Industrial production was forecast down 1%. That came in minus 4.3%. Now, they did see their
covered themselves in glory there.
Is what? Sorry,
I said the sell side have covered themselves in glory with those, haven't they?
Exactly. Yeah, that's pinning a tail on a donkey. And then we did see the trade balance improve somewhat, but activity fell again with both imports and exports in the negative for another month. Then we've been seeing German bond auctions seeing less and less interest, so that may be significant also. German Chancellor Merz, he's had to have an emergency meeting with his auto industry because they're basically on their knees due to tariffs and climate agendas. But apparently all that is good because they decided they're going to raise growth forecasts for 2025 to 0.2 from flat, and they see a whopping 1.3 coming next year, which in my mind is a bit of wishful thinking. Over to the US, as we know, we've been devoid of data, any important data from the US. But one standout I saw was the consumer credit data that we got last week, which missed by over 12 billion. Again, another feather in a cap for economists there. Now, that usually doesn't bode well for consumer spending, but I read some analysis by KPMG that showed that the top 20 household borrowers are now account for nearly 2/3 of consumer spending in the US. And that's going to be a huge problem if that 20% start putting their hands in their pockets. The shutdown is in its third week. That's led to farmers missing out on some 12 to 13 billion in aid that was offered by Trump to offset the effects of tariffs. We've seen thousands of flights delayed and cancelled due to air traffic controllers rather taking sick than working without any pay. And now the layoffs have begun, albeit in small numbers so far. There is a fine line between this no hiring and no firing, and that line is growing ever finer. And the longer this shutdown goes on, I think that there's a growing possibility that we might see the floodgates opening on some of these firings if it carries on as long as it is. Now, the RBNZ, they're another one down in New Zealand. They decided that things were so bad with the economy in the first half of the year that they needed to cut rates by a surprise 50 basis points, even while suggesting inflation was still an issue. Higher inflation was still an issue. So long story short, there's plenty of growth issue stories around that could bring a fresh wave of rate cuts for those on pause, and maybe some of those others who are holding back or going slower, they might need to play a bit of a faster catch up. And no, I'm not going to mention our bet. I'm not talking my book about our ECB bet.
I thought that's exactly where you were going with that one, so I'll let you off. Yeah, quite a lot to cover there. I think the RBNZ clearly probably more worried than they would like to admit about the slowdown that we're seeing in growth in the Kiwi economy. They do have plenty of room to cut, and they have probably been behind the curve for a number of months. The other thing with the RBNZ is they've only got one more meeting left this year in November, and then they don't meet again until next February, and the end of February at that. Basically, they seem to want a 3-month-long summer holiday. I mean, all right for some, I guess. But that does potentially mean that they need to do more now because they won't get the opportunity to do more at a later date until it could potentially be too late. In terms of some of the other stuff you mentioned, of course, the government shutdown continuing. I think this sort of data vacuum, this data void that we keep talking about, that's going to become increasingly problematic. What I mean by that is, of course, we know that a lot of, if not all of these September data releases are being delayed, although we will get the September CPI numbers next Friday. I think we're now running the real risk that some of the October data is either delayed as well or simply doesn't happen. The reason I say that is because the BLS is still shut down. There is still just one employee at the BLS, and we are now, day 2 of the October non-farm payroll survey week. So we're also looking at some of the October releases that we will get next month also being delayed or maybe even scrapped in their entirety, which again speaks to the idea that everyone is basically going to be flying blind for a lot longer than we thought, especially when there doesn't seem to be any urgency on Capitol Hill to get things up and running again. And in fact, I think the House are out of town until Thursday anyway. So I'm not entirely sure what's going on with that one. And then, lastly, as you mentioned, those German auctions, I appreciate German debt auctions are not the most stimulating of subjects to be discussed, but please try not to fall asleep. 3 of those in the last fortnight have been technically uncovered. And what I mean by that is when you account for the securities that are retained by the Bundesbank for various operational purchases, there hasn't been enough demand to soak up all of the issuance, all of the bonds that the German government, the German Treasury were wanting to sell. Now, this is important for a number of reasons, but mainly because there is going to be a hell of a lot of European fixed income supply over the next couple of months, not only out of Germany, but also out of France, assuming they can get their budgetary woes sorted out. Of course, the new Prime Minister is the same man as the old Prime Minister who quit on Monday and then got the job back on Friday. But also here in the UK, of course, we're moving rapidly towards the budget on the 26th of November, and we're going to have a hell of a lot of gilt issuance to come in the aftermath of that as well. So not a sort of market mover on its own, but a theme and a story that's worth keeping a close eye on, just as those supply worries continue to sort of bubble away under the surface.
Yeah, and we also heard this morning or a couple of hours ago that Germany going to release the debt brake as well and reclassify all their defence spending and borrowing that they have to do so it doesn't fall under that metric. So, one of the biggest fiscally responsible countries in Europe are now becoming unresponsible.
Yeah, the whole debt brake thing is becoming a little bit farcical, as you say. Things are included in it until they're not, and it's politically convenient to exclude them and borrow a little bit more. But there we are. Certainly one to keep an eye on. In any case, moving on, I want to talk about the Fed momentarily. Of course, we mentioned that sort of data vacuum that's continuing, and obviously everything that happened on Friday was overshadowed by the latest developments on the trade front. But nonetheless, we also got some news on the race to succeed Chair Powell in May of next year. And that news came via CNBC, who reported that the Treasury Secretary, Scott Bessent, has finished his first round of interviews and cut that shortlist, which did have 11 names on it, cut that down to 5. And those 5 names are reportedly current Fed governors Michelle Bowman and Chris Waller, former Fed Governor Kevin Warsh, current NEC Director Kevin Hassett, and the BlackRock Global Fixed Income CIO Rick Reeder. Now, firstly, I think we just need to pause and take a moment to reflect that our favourite for the job, David Zervos of Jefferies, doesn't look like he'll be getting the gig, which is a damn shame, to be honest, because it would have been a good old fun and games if Zervos did get the gig, and I would have loved to see some of his outfits at the post-meeting press conferences. But on a slightly more serious note, although the list has been whittled down to just 5 names, we don't actually seem to be getting any closer to getting a final name, because these CNBC reports also indicated that not only does Bessent want to conduct another round of interviews, there also needs to be a round of interviews with President Trump himself. And these sources reports noted that given all of those interviews that need to take place and the diaries of both of those cabinet members and of course the president himself, this whole thing could drag on until after Thanksgiving. Now, Thanksgiving is very late this year. It doesn't come until the 27th of November. So we could conceivably still be 6 or 7 weeks away from knowing who is going to replace Jay Powell. And of course, this time in 2017, I think, well, no, would it have been 2017? 2017, it would have been, when Powell was being picked for the top job. We knew at the end of October that he was going to get the gig. So we are working on a much slower time frame than we have seen in the past. We also got a bit of clarity on the exact mechanics of how all this is going to work, in that the new chair is likely to take over the governor spot that is currently occupied by Steve Moran at the end of January, and then be elevated to the chair position at a later date, namely in May, when Powell's term expires. Now, that reinforces a view that I put out in a note last week, which is that essentially Chair Powell is kind of yesterday's man. He's not really the story at this point. And the reason why I say that is because we've got 25 basis point cuts in October and December pretty much locked in at this moment in time. And with the government shutdown and trade risks, they only make those cuts even more likely. And then from the start of next year, his successor is very much going to be sat around the meeting table. So obviously we're going to be focused much more on what he or she is saying, as opposed to what Chair Powell himself is saying. Now, having said that, we do hear from Fed Chair Powell. He makes some remarks on Tuesday, so today when you watch this video, and we also get the September CPI numbers on the 24th of October, as I alluded to earlier on. But I think, frankly, at the moment, at least, it seems like anything Powell says or does is going to be of relatively limited impact, given that the race to succeed him is hotting up quite heavily at the moment.
Yeah, absolutely. It's something we've been looking at, since it's all started up, really. When would it be that Powell sort of becomes irrelevant? And like you say, we've pretty much narrowed down the time frame now. I think it's important to look at who the actual people are. Excuse me. We've got obviously Waller and Bowman. They're in the Fed already. They are sort of been in that line for quite some time. They've come through the central bank in varying degrees. We've got Kevin Warsh, who's ex-Fed as well, been in that environment for quite a long time. Hassett's been more of a political stalwart. He's been in various economic committees, NEC and whatever the other one was, I can't remember now. But he's been in that for 2 decades now. And then really, I think the outlier is probably Ryder, who's pretty much a Wall Street man. He has sat on the odd Treasury committee here and there, advisory board and stuff, but he's really the outsider. So I'm not sure who we go for. I think going for any of the four or the Economist and the three ex-Feds is, I won't call it keeping the status quo, but it's people we know, whereas the outlier might be Ryder and what he brings to the table.
Yeah, I think that's really important, actually, and certainly from a question of how the market is likely to digest the news when the name of who is going to succeed Powell is known. You would imagine that the sort of easiest digestion would be if it were Waller or if it were Bowman. That, as you say, is very much status quo. They're already on the FOMC. They've been on the Fed board for a number of years now. The market, they are known quantities, essentially. You could probably argue similar around Kevin Warsh, maybe a few more jitters in the market as well, just because some of the things Warsh has said in recent years. He's also had this sort of Damascene conversion from Arch Hawk, who was saying they shouldn't cut rates in the middle of the crisis in 2008, to someone who is now an uber dove, but we'll set that aside for the time being. He has been on the Fed. He knows how the institution works. I would say that Rick Reeder would also be one that markets are not unhappy with. You've got to remember that while he hasn't been at the Fed, he is a markets guy, and he has been a markets guy for 3 or 4 decades now, if not longer. So again, he knows what makes markets tick. He knows how the Fed works. I think the one that markets are really going to have a problem with if he does get the job, and I'm going to say I hope he doesn't get the job, would be NEC Director Kevin Hassett. And the reason I say that is because Hassett has been effectively Trump's right-hand man on the economy for getting on for a decade now. As you said, serving in the first administration at the CEA, then at the NEC this time out. He was also an advisor to the campaign both times, I believe, or at least would have been on the fringes of it. If Hassett were to get the job, then the market is going to get very, very concerned about the erosion of the Fed's policy independence all over again.
Yeah, absolutely. And Hassett, I think he was economic advisor to John McCain and George W. Bush. So he's really, been amongst it really for quite some time.
Yes, absolutely. So we will see how that one develops. But in any case, you're going to try and give us some wisdom now, aren't you?
Hopefully, going to try again. I like to try these now and again. So yeah, another little trading tip. And this is about how you can look to trade all-time highs. Now, technical analysis is fine to use when you've got price history to place your tech against to judge tops and bottoms. But when markets move into sort of uncharted territory, like all-time highs, that lack of price history can make it pretty hard for technical traders to trade and find those tech levels. So I've got a little bit of a tip to help you manage, identify those levels and manage your risk against them. I'm using the gold chart as an example. We have continuously moved from new high to new high. And while there are various tech tools like fib extensions and trend line extensions, they are pretty much like playing blind darts. The only certainty we have is price action. Price action tells you where the market is buying and selling at any particular time. So when dealing with an asset at all-time highs, you need to let the price action show you the levels. So in this chart, I've been marking where support and resistance comes in intraday. Those are the magenta lines. And I may draw many lines, but over time, some of those levels will become more important than others that have multiple touches either side. So then I mark them as white. I consider them levels that I would potentially look to trade. They're a bit stronger, they're showing up a bit more in that price action. Now, there's no magic. It's the market showing where the strongest buying and selling is. It's nothing to do with drawing lines or what I think. It's purely the market showing me that. And the same applies when you're looking to find a top. So many people try and pick tops in markets that are rallying to all-time highs. So what I look for is effectively a double top over a good amount of time, say a day or two or a few hours or a few days. Like we saw, as you can see on the chart there, when we got to 40.59, we had a top there, we had a pullback, we had another top there, then we had a significant pullback. So that level gave good ticks in the early hours of today, even before we then broke above. Now that break is potentially important too, because it's held as support right after we got that break. So now that level has gone from a simple magenta to a more important level, one that you can try trades against because you know where your risk is. So if you do this exercise, you can create the levels to manage your risk, find the trades, and you remove any idea of guessing where the tops and bottoms are going to be. The charts will tell you where they are going to be. And as I always say, the price action always wins.
Right. And there ends this week's episode of Art Attack with Ryan Littlestone. We will have that. What was that little plasticine Morph? Do you remember the little plasticine man that used to? We'll have him on the show next week at this rate.
Be careful what you wish for, mate.
Well, I regret saying that now. You do raise a very good point. I would add, well, firstly, how to trade an all-time high, not investment advice. The general rule of thumb is buy it because there'll be another one along in relatively short order, and that's certainly what we've seen in terms of equities and precious metals in recent weeks. The other thing that can help with this, and obviously a lot of clients have been asking these sort of questions recently, mainly around gold and silver. We're in uncharted territory. What's next? The other thing that can help is to look at some of the option flows that are going through. Where are those contracts being bought or even sold or written to the upside? You look at silver, for example, there's a lot of options interest around the $55 an ounce mark. We are literally in uncharted territory when it comes to silver, as you'll see in a moment. So looking at some of those option flows, trying to gauge where that hedging activity may come in, that can also help in terms of trying to gauge where the market may be going. But one thing that no one should ever really be trying to do is pick a top or pick a bottom. Wait until that's been confirmed, and then put your trade on if you're going to. Yeah,
absolutely. And the reason why I say it is because a lot of traders, they tend to have a sort of a mental view that something's shot up, I must sell it because it must be coming down again. And unless you have that evidence that a market is looking like it's topping, you're just going to lose money. If you lose money 10 times, 10 trades doing that, you've got to hit a huge winner just to get that money back. So there's no guarantees you can be right, even by looking at this price action. But what you're doing is you're reducing the risk of being wrong because the price has told you, I've got a high here, we've had a dip, we've got another high here. You still might be wrong, but at least you know how to judge your risk. If the level breaks, you don't need to be wrong 40, 50 bucks before thinking, oh, yeah, I'm wrong. Couple of bucks, $5. If you've broken the high, then we're off and running again. You wait, you do the same exercise, and then that just means you're not hitting loads and loads of losing trades just by guessing.
Yeah, no, absolutely. I was just looking at the numbers while you're doing that. The 13th of October, the S&P has hit 32 all-time highs this year. If you sold each of those 32 all-time highs, I'm going to give you a clue. You're not going to be sat here with a smile on your face with 60 odd trading days of the year to go.
Yeah, absolutely. But if you follow the price action, you might catch the dips that then bring you the money, and you just wait for the next one.
Indeed. Right. On that note, a nice little segue into our plays of the day. Right, so I'm going to look at silver again this week, and that's not me being lazy. It's because things have actually moved on quite a lot from where we were this time 7 or 8 days ago, with silver having printed a series of fresh record highs. And actually, as I speak, just checking here, I believe we are still north of that $50 an ounce mark. Indeed, I think we are, if my Bloomberg app would load, I'd be able to tell you that. Yes, we are 51.60 as we trade at the moment. So pretty much at fresh record highs as we record. Now, trading conditions have become incredibly choppy and incredibly volatile, and I really don't say that lightly. It probably doesn't come across on this chart, but if you've got a chart of your own on your own platform, zoom in to the last 3 or 4 days, and it's been, frankly, a mess. And the reason for that is not necessarily because of any of the tariff news that we've had, but actually because of what's going on with the underlying market. Now, I know when people are trading futures or trading CFDs or spread bets, they often don't actually think of the physical side of the market, but that's really playing a role in the silver market at the moment, because there is, frankly, just a scramble going on for physical bars of silver, of which there are not enough here in London, here in the London bullion market at this moment in time. And there's a number of reasons for that. One is just demand is gone through the roof. The second is there's been a bit of a short squeeze going on, which means people have got to cover those positions. And the third is that there is also this Section 232 probe in the United States into critical minerals. And the US considers silver as a critical mineral. So the ordinary solution to this would be, simplifying this massively, there's a shortage of silver in London, let's ship some over from New York to alleviate that shortage. Well, right now, traders don't really want to be doing that, because if you take that silver out of New York, store it in London for 3 months, by the time you want to return it to New York, the Commerce Department may say, well, hang on a minute, that's a critical mineral, we're now going to charge you a tariff on it. So that supply squeeze is exacerbating this move higher that we've continued to see. And you can see signs of that everywhere. Just anecdotally, if you speak to market participants, lease rates are at an all-time high, and the curve is massively in backwardation. The spot price is about $3 or $4 higher than the front month future, which is quite frankly ridiculous. Now, the bull case here, and I'm rambling on, is still a solid one, as we discussed last week. We've got haven demand, we've got physical demand, we've got the risk of inflation expectations unanchoring and runaway fiscal spending. The problem is this move is starting to feel very, very squeezy. And it only takes, the restoration of supply, the alleviation of some of these supply shortages for a lot of air to suddenly come out of this market and for us to, tumble $4 or $5 in relatively short order. So I think over the longer run, the balance of risk does favor further upside. But in the here and now, it certainly, if you've been long for a long period of time, it feels like time is it's the time to start getting a little bit cautious as to how much further this might run in the short term, at least.
Yeah, I don't know. So what we're doing? We're going long or we're going short?
Watching the carnage play out, I think.
All right. Well, I'm going to try and keep things a little more simpler with my trader, my play of the day this week.
Well, that's a low bar.
Excuse me. It's what?
It's a low bar compared to that.
Yeah, I was going to say, yeah, I might as well put my feet up for 5 minutes. I'll still come in under your time for that one. So nice simple tech trade this week. One of my big historical levels is down at 115, absolute massive level that's been going back for years and years. And we've been away from there for quite some months. So I'm looking to have a long there if we test it just on a first touch basis. Now, I'll obviously assess the reason why we're going there first in case it's some big news or something. Fundamentally, the shutdown is grinding on. That's still, I think, going to weigh on the dollar the longer it does ramble on. So that's going to potentially mean less downside for this. So, yeah, 115 is the area I'm looking at. We're about 60, 70 pips away from it at the moment. So maybe we'll get a look this week.
Indeed. Well, hopefully if we do get a look, it's because of some bout of dollar strength and not a massive dovish U-turn from the ECB who start hinting at rate cuts again, because that's the last thing any of us, namely me, need. Anyway, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, what you're seeing out there, and if there's anything you would like us to discuss in the next episode of The Trade-Off. And that is indeed when we will speak to you again, this time next week, back with another show. In the meantime, have a very good week ahead. Thanks as always for watching, and goodbye for now.